Next guest says that he sees the holiday commodities bull run continuing through at least January. Joining us right now is Citi Global Head of Commodities Research, Max Layton. We're also going to be sure to ask him about the impact of Angola leaving OPEC. And we can even talk about what's going on with oil as well, if you want to get into that. But Max, we have been on quite a ride. Why do you think it continues?
Sure. Yeah, I think the recent shift by the Fed, in combination with our expectation of some further China easing. So we're expecting some details on the China side. They've talked about three major stimulus paths, and one of them is affordable housing. The other one is urban village redevelopment, and third one's infrastructure. So we're expecting some real details on the urban village redevelopment over the next month or so. That, together with the light positioning across risk assets and the refreshing of people's kind of budgets at the start of next year, setting us up for this holiday bull run, as you said at the start, to continue over the next month or so.
Are you a gold bug, as they say?
For the next 6 to 12 months, yes. And we're just trying to get it right in terms of price outlook and the price direction. Yeah, I think it's pretty exciting, actually, for gold over the next 6 to 12 months. And it's certainly going to be highly leveraged to a U.S. growth slowdown. And our house view is for a U.S. recession by the middle of next year. Something of a headwind for gold, why we're not, for example, we have 2150 as the 6 to 12 month price targets trading 2050 at the moment. That's not exactly massive upside. And the headwind that we see is that we think European UK growth is going to deteriorate more quickly and more deeply relative to the US, which maybe not in the next month or so, but certainly on a 6-12 month view, we think will support a re-strengthening in the dollar, and that will be a headwind for gold.
We talk about Bitcoin all the time as a digital gold. I'm curious how correlated you think those two things actually are.
Sure. Yeah. I mean, there's some correlation, clearly, but they're quite different assets, in my opinion, both on the supply and the demand side. And so, I don't think those correlations are, where they exist, they're not things that can be relied upon. Right.
Max, walk us through how you're seeing the energy complex right now, and oil in particular, WTI. We've been talking about what's happening with OPEC and Angola. We've also been talking about just the shipping situation in the Red Sea, what kind of pressures that might put on things.
Yeah, sure. So, it's been a pretty exciting, interesting market. Big moves over the last 3 months or so. Initially, big move higher, then obviously big move lower. We had we were bearish, obviously, over the last, say, during the move lower, we were bearish on crude. And then we had a big decision to make when prices got down to around $75, $77 on Brent. And look, we decided that the dynamics around OPEC were such, and OPEC Plus were such, that it was highly likely they would extend the cuts and that they would try to protect $70 to $80 Brent. And that they would be, the base case would be that they would be successful in doing that. And that's how it's panning out. So we didn't kind of double down on the bear view at $75 and stay bearish. We went neutral to bullish. And so we've got an average price forecast of $80 in the first quarter, a balanced market with the extension of those cuts. And in fact, it's got to be said, if OPEC can kind of push full compliance, then actually you could see a small deficit in the first quarter. And that's how finely balanced it is. And obviously, the Red Sea developments have meant that there's going to be a little bit more oil on the water, which kind of tightens things up at the margin. The Angola news, as you mentioned, that was obviously like a bearish headline, but most likely to be relatively small and relatively immaterial impact on the balances. So, overall, finely balanced market, and it's well within OPEC's power to balance this market in the base case demand scenario for next year.